Over my life, I have answered thousands of questions, but there is one that still makes me laugh every time I think about it. It happened at the Daily Journal shareholder meeting in 2019 when someone stood up and asked, "Charlie, you and Warren have been partners for over 60 years. Why is Warren so much richer than you?" The room erupted in laughter. Warren's net worth at the time was estimated at about $84 billion. Mine was maybe $2 billion. That's a 42-fold difference. 42. And I know exactly why. But before I tell you the real answer, I want you to understand something. This is not a story about regret, envy, or a desire to do things differently. This is a story about choices, compound interest, and what it truly means to be rich. And if you pay close attention to what I am about to tell you, you will understand more about wealth creation than most people learn in their entire lives. When that man asked me the question, I laughed and said, "Well, he started earlier. He's probably a little smarter. He works harder." Then I paused and added, "Why was Albert Einstein poorer than me?" The room laughed again, but I was only partly joking. "Hi, Charlie. Even though you've been partners for so long, why is Warren so much richer than you?" "Well, he started earlier. He was probably a little smarter. He worked harder. There aren't that many reasons. Why was Albert Einstein poorer than me?" The truth is that wealth accumulation and intelligence are only loosely connected. Einstein was one of the smartest people who ever lived. He died with a net worth equal to maybe 1 million in today's dollars. Meanwhile, I am sitting here with a net worth of over 2 billion, and Warren has over 80 billion. Does this mean that Warren and I are smarter than Einstein? Of course not. It means that we understood something that Einstein didn't spend much time thinking about: the power of compound interest, applied systematically over very long periods of time. That is the whole secret. Everything else is just details. But these details matter enormously because they make the difference between 2 billion and 80 billion. Let me tell you the real story of why Warren is so much richer than me. It comes down to 4 fundamental differences in how we approached wealth creation over 7 decades. And by the time I finish explaining these differences, you will understand not only why our net worths diverge so sharply, but more importantly, how you can apply these exact same principles to your own financial life, regardless of where you are starting from. The first reason Warren is richer than me is simple. He started earlier and never stopped. I met Warren in 1959. I was 35 years old. He was 29. By that point, I had already made my first $1 million in real estate development and some side investments. I thought I was doing pretty well. I had a law practice that brought in a good income. I had a few successful real estate deals under my belt, and I was living comfortably. Warren, on the other hand, was managing a small investment partnership in Omaha. He had been investing seriously since he was about 11 years old. By the time I met him at 29, he had already been compounding money for 18 years. 18 years. That head start alone explains a massive chunk of our wealth gap. But it's not just that he started earlier. It's that he never stopped. From age 11 right up to today at 93, Warren has invested continuously. That is 82 years of continuous compounding. I didn't start investing seriously until my mid-30s and took breaks along the way to focus on other things. That is 40 years of compounding versus 82 years. The math behind this difference is staggering. Let me give you a concrete example of how this works. Let's say you invest $10,000 at age 20, and the amount grows at 20% a year. By age 60, that $10,000 turns into roughly $9 million. Now suppose you wait until age 35 to invest that same $10,000 at the same 20% return. By age 60, it will be worth about $200,000. The same investment amount, the same return, but a 15-year head start turns $200,000 into $9 million. That is a 45-fold difference simply because you started earlier. Now extend that to Warren's 82 years versus my roughly 60 years of serious investing, and you begin to see why the wealth gap exists. But there is another element to this that most people miss. Warren didn't just start earlier, he scaled faster. By his 30s, Warren was already managing significant sums of money through his investment partnerships. He reinvested every dollar of profit back into finding new opportunities. He lived on a tiny fraction of what he earned and let the rest compound. I was more balanced in my approach. I liked making money, but I also liked spending it on things I cared about. I gave money to causes I believed in. I lived well. I didn't optimize everything purely for wealth accumulation. Neither approach is right or wrong, but over time, they lead to vastly different outcomes. Every dollar Warren reinvested in his 30s and 40s has now been compounding for 50 or 60 years. Every dollar I spent or gave away immediately stopped earning returns. The math of compound interest is relentless. It rewards patience and punishes consumption. Warren understood this on an instinctive level from a very young age. I understood it intellectually, but I didn't organize my entire life around maximizing it the way Warren did. The second reason Warren is richer than me is that he made better decisions about what to own and when to sell it. Specifically, he almost never sold anything. I, on the contrary, sold things too early. Let me give you the most painful example. In 1996, I owned roughly 18,000 Class A shares of Berkshire Hathaway. At today's prices, that's about $600,000 per share. That stake would be worth nearly $11 billion. $11 billion. If I had simply held those shares and done nothing else with my financial life, today I would be worth over $11 billion. Instead, I'm worth about $2.5 billion. What happened to the other $8.5 billion? I gave away a large portion of those shares to charity over the years. Now, before you think I'm complaining, let me be clear. I don't regret those donations. They went to universities, hospitals, and causes that were important to me. The money did real good in the world. But purely from a wealth accumulation standpoint, giving away appreciating assets is the biggest mistake you can make. Here is why. If I had held on to those Berkshire shares until they fully appreciated and then gave them away, the charities would have received more money and I would have retained more wealth. It is a win-win scenario that I didn't fully appreciate at the time. Let me show you the math. If I had given away one Berkshire share in 1996, when it was worth about $35,000, that charity would have received $35,000. If I had held that share until today, when it is worth $600,000, that same charity would have received $600,000. That is 17 times more benefit to charity from the exact same single share, simply by waiting 27 years. Meanwhile, if I had kept half of my shares and given the other half away after they appreciated, I would have given more absolute dollars to charity overall, while retaining significantly more personal wealth. Warren understood this principle completely. He intends to give away almost his entire fortune to charity, but he is doing it strategically. He held his Berkshire shares while they compounded and donates appreciated shares of other companies or pledges to give them away upon his death. This allows for maximum compound growth before the wealth transfer, meaning ultimately more money goes to charitable causes, while he retains control and the benefits of compounding during his lifetime. I thought linearly, not exponentially. I thought, I have the money now. Causes need money now. I should give it now. It is compassionate, but mathematically suboptimal. An exponential thinker says, if I wait, this money will grow significantly, and I will be able to give much more while keeping more for myself. This is not greed. It's simply smarter math. This principle applies not just to charity. I sold investments too early throughout my career because I was thinking in absolute dollars, not in compounding growth rates. I would buy something for $1 million, sell it for $5 million, feel smart about my 5 times return, and move on to something else. Warren would buy something for $1 million and never sell it. 40 years later, it would be worth $500 million. His single 500 times return beat my 5 times return 100 times over. The difference is that I was playing the game of getting a good return on individual investments. Warren was playing the game of maximizing lifetime compound growth. These are two completely different games with completely different outcomes. Most investors play the first game because it feels more active and provides more frequent feedback and validation. Warren played the second game because he understood that is where the real money is made. The third reason Warren is richer than me is temperament. He has better emotional control over money than anyone I have ever met, including myself. And I consider myself fairly rational in financial decisions. Let me give you a concrete example from the 1970s. We had both invested heavily in Berkshire Hathaway, which was going through severe market volatility. There were periods when our holdings lost 30% or 40% of their value in a matter of months. I remember feeling genuine anxiety during some of those drawdowns, not panic, but discomfort. I wondered, did we make the right decisions? Should we sell some shares and diversify into safer assets? Are we too concentrated in a single investment? Warren's reaction was completely different. The stocks you want to own are selling at discounted prices. If you are not thrilled when the stocks you want to own are selling at a discount, you don't understand investing. He wasn't just saying this to reassure me. He genuinely felt that way. His emotional reaction to market volatility was the opposite of normal human psychology. When prices dropped, he grew happier. When prices rose, he grew more cautious. This emotional edge accumulated over decades. During every market crash, Warren bought aggressively while others panic sold. During every market bubble, he sold overvalued positions or simply held cash while others bought at the peak. This wasn't because he had better information or superior analytical skills. It was pure emotional discipline. He had trained himself to feel excitement when others felt fear, and caution when others felt greed. I had decent emotional discipline, probably better than 99% of investors. But Warren's discipline was in an entirely different category, and that slight difference in emotional control repeated across thousands of investment decisions over 7 decades. turns into a massive difference in wealth. There's a story that perfectly illustrates this. During the 2008 financial crisis, Berkshire's stock price dropped from roughly $140,000 a share to under $70,000. Warren's net worth was cut roughly in half in less than a year. The financial media was wondering if Berkshire would survive. Some famous investors were saying that Warren had lost his touch, that he was too old, that the world had changed and his methods no longer worked. Anxious friends and shareholders were calling me, asking, should we change our strategy? Should we sell some positions and raise cash? Should we be doing something differently? Warren's response was to write an op-ed in the New York Times titled, "Buy American, I Am." He then deployed billions of dollars into investments in companies like Goldman Sachs and General Electric on terms that were highly advantageous to Berkshire. Those investments made us tens of billions of dollars in the subsequent years. Warren's ability to remain completely rational and even opportunistic during the worst financial crisis since the Great Depression demonstrated a level of emotional control that very few investors possess. I handled the crisis well. I didn't panic. I didn't sell anything in the heat of the moment. But I also wasn't as aggressively opportunistic as Warren. I was more focused on preservation than on maximizing the opportunity. It is a subtle difference, but it is the difference between extraordinary returns and just very good returns. And over a lifetime of investing, these subtle differences in emotional reactions compound into the wealth gaps we are discussing. The fourth reason Warren is richer than me is that he optimized his entire life for wealth accumulation in a way I never did. Warren lives in the same modest house in Omaha that he bought in 1958 for $31,000. He drives old cars. He eats relatively simple food. He doesn't have a yacht, multiple homes, or expensive art collections. His personal consumption has remained remarkably low, even as his wealth grew into the tens of billions. This is not because he is cheap or doesn't appreciate nice things. It is because he made a conscious choice to maximize the gap between what he earns and what he spends, thereby maximizing the amount of capital available for compounding. I made a different choice. I lived comfortably. I owned nice houses. I traveled extensively. I spent money on things I cared about, including art, books, and experiences. I gave hundreds of millions of dollars to organizations and institutions I believed in. None of these choices were mistakes from the perspective of life satisfaction. I have had a wonderful life and made a positive impact on the world. But every dollar I spent on consumption or gave away to charity was a dollar that stopped compounding. Warren kept nearly every single dollar working for as long as possible. Over 70 years, this difference in consumption patterns snowballed into a difference of billions of dollars in wealth. Here is the math. Suppose Warren and I both earned $1 million in 1960. I might have spent $200,000 on consumption and given $100,000 to charity, leaving $700,000 to invest. Warren spent maybe $50,000 and gave almost nothing away, leaving $950,000 to invest. That is a $250,000 difference for 1 year. Not huge, but now apply compound interest to that $250,000 at 20% annually over 60 years. That difference in consumption and charity from just 1 year turns into over $60 billion. $60 billion just from different choices made in a single year. Now multiply that by 60 years of earning, and you start to see how consumption patterns turn into massive disparities in wealth. Warren understood something profound. Every dollar has two values: its present value, what you can buy with it today, and its future value, what it will become if you invest it and let it grow. Most people focus almost entirely on the present value. They think about what they can buy, what they can enjoy, what they can do with the money right now. Warren focused almost entirely on the future value. He thought about what every dollar would become in 10, 20, or 30 years if he invested it wisely and let it work. This required sacrificing the present to maximize wealth in the future. It meant living well below his means for decades. It meant passing on consumption opportunities that most wealthy people automatically accept. Was this the right choice? That entirely depends on what you are optimizing for. If you are optimizing for maximum wealth accumulation, then it is absolutely the right choice. If you are optimizing your life for experiences, current impact, or balanced enjoyment, maybe it is not. I chose a more balanced path. I wanted to enjoy some of my wealth while I was young enough to appreciate it. I wanted to make an impact through philanthropy during my lifetime, so I could see the results. I wanted to live well, not just accumulate numbers in a bank account. It was a conscious choice, and I am happy with it. But I also recognize that it cost me tens of billions of dollars in ultimate net worth. That is the price of the trade-off. You cannot maximize everything at once. You must choose what you are optimizing for. Warren chose to optimize for wealth accumulation above almost everything else. I chose a more complex optimization that included present enjoyment and impact alongside capital creation. Both approaches are valid, but only one leads to becoming one of the richest people in human history. Now let me tell you something that might surprise you. There is actually a fifth reason Warren is richer than me, and it's one we both rarely discuss publicly. Warren is better at playing the long game psychologically. He's more patient, more focused, and more resistant to distractions than almost anyone I have ever known. Let me explain what I mean. Successful investing over long periods requires ignoring a massive amount of noise. Every day there are news events, market movements, economic data releases, company announcements, analyst opinions, and countless other inputs that could potentially influence your investment decisions. Most investors react to this constant stream of information. They read something alarming and sell. They read something exciting and buy. They constantly adjust their positions based on new information. Warren has an almost supernatural ability to ignore the noise and focus only on what truly matters. He reads constantly, but filters information through a very specific lens. Does this change the fundamental long-term value of the business I own? If the answer is no, he ignores it completely. I am pretty good at filtering out the noise, but Warren is exceptional at it. He can sit through years of market volatility, economic uncertainty, and media criticism without changing his core positions or strategies. This ability to maintain focus on long-term fundamentals while everyone else reacts to short-term noise is incredibly rare and incredibly valuable. Here is a concrete example. In the late 1990s, during the dot-com bubble, Berkshire shares significantly underperformed the broader market. Tech stocks were soaring, while Berkshire, which owned boring old economy businesses, lagged far behind. The financial media was ruthless. Articles were written questioning whether Warren had lost his touch, if his methods were outdated, and whether he needed to adapt to the new economy. I remember reading some of these pieces and feeling defensive. I wanted to respond, to explain why we were right and the market was wrong, to justify our approach. Warren's reaction was to do absolutely nothing. He didn't change his strategy. He didn't start buying tech stocks to keep up with the market. He didn't even bother responding to the criticism. He just kept doing exactly what he had always done, buying good businesses at reasonable prices and holding them forever. Then the bubble burst. Tech stocks crashed, and Berkshire's approach was completely vindicated. But Warren didn't gloat or say, "I told you so." He just kept doing the same thing. This ability to stay focused on your strategy regardless of outside noise or criticism has enormous value over time. It prevents you from making emotional decisions during bubbles and crashes. It keeps you in good assets when everyone else is selling. It allows compound growth to work uninterrupted over very long periods. I had decent focus and discipline, but Warren is truly exceptional. And this slight difference, maintained over 70 years, makes a massive contribution to our wealth gap. Let me tell you what all this means for you practically. You are probably not going to become as rich as Warren Buffett. Neither am I, and I was his partner for over 60 years. But you can absolutely apply these principles to build significant wealth over your lifetime. First, start as early as possible and never stop. Every year you delay starting is a year of compounding growth that you are giving up forever. If you are 20, start now. If you are 40, start now. If you are 60, start now. It is never too late to benefit from compound growth, but earlier is always better. Second, be very careful about selling assets that are compounding well. My biggest financial mistake was giving away Berkshire shares that subsequently skyrocketed in value. You may not own Berkshire shares, but the principle applies to any good investment. If you own something that truly grows in value over time, hold on to it. Don't sell just because you made a profit. Don't sell to diversify into something you understand less. Don't sell to buy something more exciting. Just hold it and let it compound. Third, develop emotional discipline around money and investing. This is harder than it sounds, but it can be learned. Start by understanding that your emotional reactions to market volatility are usually wrong. When you feel panic and want to sell, it is often the best time to buy. When you feel euphoric and want to buy more, it is often the best time to be cautious. You can train yourself to recognize these emotional triggers and do the opposite of what they are telling you. Fourth, be conscious about what you are optimizing your financial life for. If you want to maximize wealth accumulation, you need to minimize consumption and maximize the amount of money you invest. If you want to balance wealth creation with present enjoyment and philanthropy, that is fine. But understand the trade-offs you are making. The key is to be intentional about your choices rather than drifting into consumption patterns without thinking about the long-term costs. Fifth, ignore the noise and focus on fundamentals. Stop checking your investment accounts every day. Stop constantly reading financial news. Stop reacting to market movements and economic forecasts. Instead, focus on owning good assets, holding them for long periods, and letting compounding do its work. Most investing success comes from not doing stupid things, rather than doing brilliant things. These principles sound simple, and they are. But simple does not mean easy. Applying them consistently over decades requires a discipline that most people simply don't have. That is why most people don't build significant wealth, even when they have the income and opportunities to do so. When I reflect on the question of why Warren is so much richer than me, I realize that the answer reveals something important about success in general. Warren didn't become incredibly wealthy because he is fundamentally different from other successful investors, but because he is consistently better at a few key things and maintained those edges for an incredibly long time. He started earlier and stayed invested longer. He almost never sold winning positions. He had better emotional discipline during market volatility. He optimized his consumption patterns for maximum capital accumulation, and he ignored the noise better than almost anyone else. None of these advantages is dramatic on its own, but compounded over 7 decades, they create the wealth gap we see today. This is actually encouraging if you think about it. You don't need to be a genius to build significant wealth. You don't need to take massive risks or find the next big thing. You just need to be slightly better than average at a few key things and sustain those edges consistently over time. Time and consistency will do most of the work for you. The biggest risk to your financial success isn't a few bad investments. It's quitting too early, getting distracted by short-term results, or constantly changing strategies. Warren's greatest advantage is perhaps simply that he stuck to the same basic approach for 70 years, while everyone else chased new strategies every few years. There is one last thing I want to say about this. The question of why Warren is richer than me implies that being richer is automatically better. I don't think that is the case. Wealth is a tool to achieve goals, not a goal in itself. The question you should be asking is not how do I accumulate as much money as possible, but how much money do I need to live the life I want and make the impact I want to make. Warren chose to maximize wealth accumulation, and he achieved spectacular success in that goal. But that choice required sacrifices. He lived frugally, worked constantly, and deferred a massive amount of consumption and philanthropy. I chose a more balanced approach, enjoying my wealth along the way and donating to charity while I could still see the results. I am entirely satisfied with my choices. Both approaches are valid, but they require different strategies and lead to different outcomes. The main thing is to be intentional in your choices, not to drift into patterns without considering what you are optimizing for. If you want to maximize net worth, study Warren's approach closely and be prepared for the sacrifices it demands. If you want balance, create your own approach based on these principles, but adjusted to your values and goals. Whatever you choose, understand that building wealth is about making consistently good decisions over very long periods. It's about avoiding major mistakes that can wipe out years of progress. It's about recognizing that small advantages turn into massive ones if given enough time. You don't need to become Warren Buffett to achieve financial security and independence. You just need to apply these principles consistently over time, on whatever scale makes sense for your situation. Start early, or start now if you didn't start earlier. Hold on to good investments and let them compound. Develop emotional discipline to think long-term. Be intentional about consumption versus investing, and ignore the noise by focusing on fundamentals. Do this consistently for 20, 30, or 40 years, and you will become wealthier than you probably imagine possible right now. Not as wealthy as Warren, but wealthy enough to achieve your goals and live the life you want. And ultimately, that is what matters. Not the absolute size of your wealth, but whether it is enough for your goals. So when someone asks you, 30 years from now, why some other investor is richer than you, I hope you can give an answer that shows you made intentional choices about what you optimized your financial life for. Because that is what separates successful people from everyone else. Not the size of their bank accounts, but the intentionality of their decisions and the consistency of their execution over time. Now let me tell you about something else that contributed to our wealth gap and that most people never think about. Warren has what I call investment stamina. This is different from patience. Patience is waiting for the right opportunity. Stamina is continuing to make the right decisions, even after you have already won the game. Most people, once they make enough money to live comfortably, relax, they start spending more. They take longer vacations. They buy nicer things. They give themselves permission to ease up because they've earned it. By the way, there is nothing wrong with that. It is absolutely rational human behavior. But that is not what Warren did. Even after Berkshire made him a billionaire, and then a multi-billionaire, he continued living in the same house, eating the same food, and reinvesting every dollar with the same discipline he had when he started out. I watched this for decades. We had years when Berkshire generated billions in profit. Warren's personal share of that profit was enormous, and he spent maybe $50,000 of it on personal consumption. The rest went straight back into finding new investments. I was more normal in this regard. Once I had enough money to be comfortable, I started enjoying it more. Not excessively, but I was no longer optimizing every dollar for maximum compound growth. I took nice trips. I donated to causes that were important to me. I bought things I wanted. Warren just kept compounding year after year, decade after decade, never slowing down, never declaring victory, and never relaxing his discipline. That is stamina. This ability to continue optimizing for wealth accumulation even after you have already won is extremely rare. And over time, it turns into an enormous wealth gap. Think about it mathematically. By the 1980s, Warren and I were already rich enough to stop working, live comfortably for the rest of our lives, and still have money left to leave to charity and family. But we still had 40 years ahead of us. Warren spent those 40 years reinvesting every dollar and continuing to compound capital at high rates. I spent those 40 years living well, giving generously, and yes, still compounding capital, but not with the same single-minded focus. The difference over 40 years of continuous compound interest is the difference between 2 billion and 80 billion. Most people think the hardest part is getting rich in the first place. Warren taught me that this is not true. The hardest part is staying disciplined after you are already rich, because that is when the temptations are greatest, and the conscious need to remain disciplined is lowest. Here is another aspect of our wealth gap that people don't appreciate. Warren made fewer mistakes than I did. Not dramatically fewer, maybe just 1 or 2 major mistakes fewer over the decades, but over 70 years. Those avoided mistakes snowball into billions of dollars in wealth difference. Let me give you a concrete example. In the early 1970s, I invested in a business that I thought was undervalued. The analysis was sound, the price was reasonable, but I didn't understand the industry as well as I thought I did. The investment lost about 60% of its value before I finally admitted the mistake and sold. That single mistake cost me maybe $3 million at the time. Not catastrophic, but significant. If I had avoided that mistake, and instead invested that $3 million in Berkshire at 1972 prices. Today, it would be worth over $500 million. One mistake, one moment of overconfidence in how well I understood an industry, and it cost me $500 million in lost opportunity. Warren made mistakes too. Every investor makes them, but he made slightly fewer of them than I did. Maybe he was more honest with himself about the limits of his knowledge. Maybe he was more disciplined about staying within his circle of competence. Maybe he was just luckier at avoiding situations that would expose his blind spots. Whatever the reason, this slight difference in mistake frequency, multiplied over 70 years, accounts for billions of dollars in wealth difference. This is why Warren always says that investing success is not about making brilliant decisions. It's about avoiding stupid decisions. If you can avoid major mistakes and simply make good enough decisions consistently, compound interest will make you rich over time. Investors who fail are usually the ones who make one or two catastrophic mistakes that wipe out years or decades of progress. Warren's true genius lies not in finding amazing investments, though he did that. It lies in consistently avoiding the mistakes that would have derailed his compounding. There is also a psychological dimension to our wealth gap that is worth discussing. Warren genuinely does not care what other people think of his investment decisions. I care a little bit, not a lot, but enough that it occasionally influenced my decisions. Let me explain what I mean. Over the years, there were times when Berkshire's stock lagged the market, and people questioned our approach. During those periods, I felt a certain pressure to do something differently, to chase performance, to prove the critics wrong. Warren felt no such pressure. He was completely immune to outside opinions about his investments. If he believed a decision was right based on his analysis, he made it, regardless of what anyone else thought. This psychological independence is incredibly valuable because it prevents you from making reactive decisions driven by social pressure or criticism. I remember in the late 1990s, during the tech bubble, we were constantly asked why we weren't buying tech stocks. Other value investors were starting to buy them. The media hinted that we were obsolete. Even some of our own shareholders were growing impatient. I felt that pressure, not strong enough to change our strategy, but enough to bother me. I wanted to explain myself, to defend our approach, to make people understand why we were right. Warren felt none of that. He didn't care if people thought we were wrong. He didn't care if Berkshire underperformed for a few years. He just stuck to his principles and waited for the market to come around to his point of view. And of course it did. The bubble burst, tech stocks crashed, and our approach was vindicated. But Warren would have stuck with it even if he had been wrong, even if tech stocks kept going up forever, because he made decisions based on his own analysis, not on what other people thought he should do. This independence of mind, maintained consistently over 70 years, prevents a multitude of mistakes. It keeps you from chasing returns in overvalued markets. It keeps you from abandoning good strategies during temporary periods of underperformance. And it allows compounding to work uninterrupted by emotionally driven strategy shifts. I had more independent thinking than most investors, but Warren's independence was absolute. And this difference, small but constant over decades, contributed to our wealth gap. Let me tell you about another factor people never talk about. Warren was luckier than me in some specific ways that made a massive difference in wealth accumulation. I know this sounds strange because we both had incredibly fortunate lives and careers, but there are specific instances where, luck played a role in our diverging outcomes. For example, Warren happened to meet the right people at exactly the right time in his career. He met Ben Graham, his mentor, at Columbia Business School. He met me at exactly the moment when we were both ready for a partnership. He happened to be in the right place, in the right industries, at the right time to capitalize on major economic shifts. I was lucky too, but not quite as much, and not at as many critical junctures. It is a small difference, but over 70 years, small differences in luck compound exactly the same way small differences in skill or discipline do. This doesn't diminish Warren's accomplishments in the slightest. He created the conditions for luck to find him by being prepared, constantly learning, building relationships, and staying in the game long enough for lucky circumstances to arise. But it is important to acknowledge that luck played a role. Part of the difference between 2 billion and 80 billion is luck. A small part, but some. And that is okay. That is how life works. The key is to position yourself so that when luck arrives, you are ready to take advantage of it. Warren did this better than almost anyone else. He had cash ready when opportunities appeared. He had the knowledge to recognize them quickly. He had the courage to act decisively. So when luck presented opportunities, he extracted the full value from them. I was pretty good at this too, but Warren was exceptional. And over 70 years, exceptional beats pretty good by a massive margin. All of this brings me to what might be the most important lesson of this entire story. The question of why Warren is so much richer than me isn't really about Warren and me at all. It is about principles that apply to anyone trying to build wealth over a lifetime. The exact numbers are different for everyone, but the basic dynamics are the same. Small advantages in starting time, holding periods, emotional discipline, consumption patterns, and avoiding mistakes. These small advantages compound over time into massive differences in wealth. You can see this in any field. The best athletes are not 10 times more talented than other professional athletes. They are maybe 5 or 10% more talented, but they maintain that slight edge over an entire career, and it translates into championship rings and glory. The most successful companies aren't 10 times better than their competitors. They are a few percent better at key metrics like customer service, efficiency, or innovation. But they maintain those slight advantages for decades, and it translates into market dominance. And the wealthiest investors aren't 10 times smarter than other successful investors. They are a little more disciplined, a little more patient, a little better at avoiding mistakes, and they maintain these small edges over a lifetime, translating into the wealth gaps we are discussing. This is actually great news for most people. It means you don't need to be Warren Buffett to build significant wealth. You don't need to be a genius, take massive risks, or be incredibly lucky. You just need to be slightly better than average at a few key things and maintain those edges consistently over long periods. Start a little earlier, hold a little longer, react a little less emotionally to volatility, spend a little less of what you earn, make slightly fewer mistakes. None of this requires genius. It only requires discipline and patience. But if you can do this consistently for 30 or 40 years, compound interest will make you richer than you probably imagine possible right now. So yes, Warren is much richer than me, and now you know exactly why. Not because of 1 or 2 brilliant decisions, but because of thousands of small advantages maintained consistently over 7 decades. That is the true secret to building exceptional wealth. Not genius, but consistency.